Thanks, Sam. Thanks for the warm introduction, and great to be on another Wonder session. So let's have a look at the agenda. So in terms of what we're going to cover today, I'll do a brief introduction on kind of how I got to sitting here talking to you about term sheets and everything legal. Brief intro on what FounderCatalyst does, and then we'll dive into the detail. And effectively, this is on going to cover a couple of areas. Firstly, I'll do an introduction into the curious creature that is the term sheet. So where does it fit into a funding process? What does it contain? What doesn't it contain? And the caveats around that. And then we'll dive into some of the funding round legal terms that are embedded and kind of distilled into that term sheet. And then, as Sam said, right at the end, we'll have Q&A to fit with the format of the Wonder session. So without further ado, let me just say hi. So I guess by intro, I'm an exited founder myself, but let's go back a bit before that. So for the first 15 years of my career, I was a normal employee. Went from being a junior engineer up to technical director in a business, and then became director of project services, and had about 130 reports, and about 230 million pounds worth of projects that I was responsible for. So that was great. It was a private equity backed buy and build business. Unfortunately, they ran out of cash, so they borrowed too much, couldn't repay the debt. And then in January 2013, right at the end of the month, they told everybody that the company had run out of cash and had basically closed. So it closed overnight, which was eye-watering. So I started another business pretty much the next day, and that was a really fun journey. And this is where I call myself an accidental entrepreneur, because I had no intention of ever being an entrepreneur. But once you are, I think it's a bug, and yeah, I'm not giving up now. So I started an IT company anyway at the start of 2013, and we grew that from 0 to 27 million in just over 3 years. So we picked up lots of great awards, things like Sunday Times Tech Track, second fastest growing company in the UK, and Financial Times 17th fastest growing company in Europe. So really, really interesting journey with all of the trials and tribulations. I mean, it sounds great now on paper, but you don't grow a business that quickly without having all of the usual problems. So working capital, cash flow challenges. We made about 100 hires in that period, and not every one of those hires was great. The management team was a little bit dysfunctional and argumentative at times, but anyway, the outcome was brilliant. When we won all the awards, my co-founders were talking about doing a buy and build strategy, so buying loads of businesses and bolting them together, which is exactly what 2E2 did. Now, you probably remember that 2E2 didn't end that well for everybody involved. So I decided to leave my co-founders to the journey in 2017. I had no interest in being involved with another buy and build business. So I exited in September 2017 to private equity, and then pretty much the next day, started angel investing. So I've been angel investing for just over 6 years now, and this slide's slightly out of date, but I've got 32 investments now. So about $750,000 invested across those investments. And I kept bumping into new founders who had really great ideas. They were at pitch events, but just had no idea how to navigate the process from, you've got a shiny pitch deck, you know what you want to achieve, you need cash, but you don't know how to go about getting that cash. And it's a really, it's a relatively opaque process and scary for anybody without kind of that background. So I started FounderCatalyst, and that the aim of FounderCatalyst is to scratch an itch for me. It is to help founders navigate what is a complex and scary process. So let me just tell you a little bit on what FounderCatalyst does, and then we'll dive into the reason why you're here, the interesting detail. So FounderCatalyst does effectively 4 things. The first is we offer a whole bunch of free stuff on our website. So things like employment contracts, advisor agreements, term sheets, funny enough, which is the topic of today, cap table modeling tools, and things like that. We don't ask for an email address even, it's just available for free. And all of the stuff there is lawyer quality. It's written by our in-house chief legal officer, and is the kind of things you'd pay hundreds and hundreds of pounds for anywhere else. We then help people get SEIS and EIS advance assurance. Now, we're not going to cover much of that today, but those are amazing tax relief schemes for investors in the UK. And long story short, if you're an early stage business looking for funding and you don't have SEIS and EIS advance assurance, you're really going to struggle to get funding. So it's kind of table stakes for any founder wanting to talk to investors. We've got an amazing track record getting advance assurance from HMRC, and we can, complete your submission same day. And we routinely get responses back from HMRC with a positive thumbs up next business day. And we don't charge for this as a discrete service. It's for free when you sign up for the legal documentation, which we'll cover next. In order to do a funding round, you need lots of legal docs, and I'll talk to you about those in 2 slides, actually. But we produce all of those via a SaaS platform. It's self-service, so you enter details of you, your company, your funding round. We create loads of docs. You invite your investors, and ultimately you close your funding round on our platform, all supported by real humans to hold your hand throughout the journey. And finally, we make introductions between our customers and potential sources of funding. 2 things that make us unique, just to finish off quickly. Firstly, everything we do is 1,495 ex-VAT. For everything we've mentioned, there are no monthly fees, hidden fees, or percentage of raise. And secondly, when you're working with us, you're working with exited founders that are also angel investors. So you're not talking to a grad with a crib sheet, you're talking to a team that's actually walked the walk. Enough about that. Let's have a quick look into the term sheet. And what I wanted to cover off first is where a term sheet fits into a funding round process. Now, there are 3 main ways in the UK of closing a funding round. Well, let's cover the things that you don't see in the UK. That's a much more interesting way to look. So within the UK, you can use ASAs, you can use what's called a priced round, which is shown here, or you can use agile fundraising. Those are the 3 real ways you see funding round closed in the UK. In America, you get other more exotic instruments, things like convertible loan notes and safe notes and things like that. Within the UK ecosystem, they're very, very rarely seen because they're not compatible with that SEIS and EIS investment scheme we mentioned before. And that means that people, UK investors, if they want to make use of those amazing tax incentives, and by the way, they can't use safes and convertible loan notes and things like that. What we've got on the screen here is a priced round. So that is one of the ways of doing a funding round in the UK. And you can see there's lots and lots of documentation. And don't worry, we help you navigate all of this stuff. We've broken this down into the 5 key stages of achieving a funding round. The first stage is getting your SEIS and EIS advance assurance. You don't need a term sheet for this, actually. You then go through a pitching process. And so as an angel investor myself, what are the 4 things I want to see every time I see a new opportunity to invest in? First is the pitch deck, which is completely standard and obvious. I would next want to see a forecast model, ideally 3 years plus, and 5 years if necessary to show the business in a good light. I'll then want to see the term sheet. And then I'll want a copy of your SEIS and EIS advance assurance to prove that you are eligible under those tax relief schemes. So you need a term sheet initially during pitching. You then come on to a phase about onboarding investors. So before you engage properly with investors and open the kimono, you want them to sign 3 things ideally. Firstly, an NDA or a confidentiality agreement. When you're going through due diligence, speaking to investors, they will understand quite a lot about your business. They will understand what your details potentially of your existing shareholders. They'll understand, you may have to disclose details about your employees and your your org chart, that you may share kind of secret information or know-how or whatever. So there's lots of things you'll be sharing that you don't want to do so without an NDA. The FCA consent or disclaimer. So raising funding in the UK is a regulated activity by the FCA, and therefore, in order to speak to angel investors, you should get them to sign an FCA disclaimer or consent first. And finally, we come to the term sheet again. Let's park that to the next slide, but I'm just putting in context when you use the term sheet. The term sheet is actually a really curious instrument because typically at the point of onboarding investors, you would get them to sign the term sheet, which is signifying their intent to invest, or at least their strong interest. And then effectively you throw away the term sheet. It gets put in a drawer and nobody ever reads it again. It's never, out of all of these documents, it's the only document really that gets put in a drawer, nobody ever refers to, and we'll cover why in a moment. You then come to do a funding round, and you can see there's lots of documents there. Let's pick on a couple. So the shareholders agreement is roughly 50 pages. The articles of association are another 40 pages. There's loads and loads and loads of detail within those documentation. And actually, when you're negotiating with your investors at a high level, the devil is not in the detail. Really, you want to discuss what are the key principles of the investment? What does the investment look like? What are the key things? And you can do that using the term sheet. That's exactly the purpose of the term sheet. Of course, at some point in the future, your investors or their lawyers may want to read, and almost certainly will read, the minutiae of the shareholders agreement article. So your negotiation isn't complete. But what you're trying to do by releasing the term sheet earlier is agree those massive big things, the rights and protections that you'll be offering your investors, so that you can kind of focus on the important stuff to start with. So you then complete the funding round. I won't cover any of the other the documents here. All you need to know are there are lots of documents, lots of people sign them, there's lots of detail, they're quite big. And that's why the term sheet is brought out ahead of that. And then post-round, you've got some obligations as well. You've got to give your investors share certificates, you've got to file SHO1s, you've got to complete a process to formalize the SCIS share issue process as well. We won't cover that at all today, and honestly, the term sheet doesn't help in any way with that part. So we're really focusing on how the term sheet helps with pitching and then helps with onboarding investors. So let's take a look at how it does that. So what is the term sheet? Let's take a step back. The term sheet is a relatively small document, so it's usually 4 or 5 pages. And it's much more accessible. So you saw some of the other documents there, the shareholder agreement and articles of association. If you're not a lawyer or you don't read these things every single day, then actually those documents are very, very, very legally dense. They're also 50 pages each. And actually, it's really hard reading a document. Not only do you have to read the words that are there, so we will give the investor this right and we will give the investor that right and so on and so forth. But also, as an investor, you've got to read the documents and understand what's missing. So words, the words may be in there that, may not be in there around information rights. And if something's not expressly stated in those documents, then, the chances are you're not getting that right and protection. So it's not only reading a document to see what's there, it's to see what's missing. The clever lawyers have produced this concept of a term sheet, which takes all of those hundreds of pages of documentation and squeezes it, distills all of that detail into the document called a term sheet, which, like I say, is 4 or 5 pages. A term sheet is not usually legally binding. So even though a term sheet is signed by both the investor and the founder, so everybody signs that, 99% of the document isn't legally binding. So the confidentiality clauses, usually the no fees, so nobody charges anybody for producing a term sheet. And other than that, and the term sheet is almost entirely legally non-binding, which means that by signing a term sheet, your investor is not committed to investing. And as a founder, you're not committed to taking on the investor either. So it's not an obligation for either party to complete the transaction. It's just kind of signaling intent. In early funding rounds, then it's usually almost certainly the founder that produces the term sheet. So one of the early jobs as a founder is getting your head around how to produce a term sheet. And by the way, you can produce one for free on FounderCatalyst. When it comes to later funding rounds, so typically the first couple of funding rounds in the UK are SEIS and EIS investors, and you as a founder will be responsible for producing this doc. When you get past that and you come on to VCs or crowdfunding or institutional investors, any of those more sophisticated investors, the game changes entirely, and those investors will produce their own term sheet. So they will send you a term sheet which supersedes yours. So, but yeah, for early stage deals, angel investors in the UK will expect you to have a term sheet and you to understand your term sheet as well. So if a term sheet isn't legally binding, what's its use? Well, actually, there's a couple of really good uses for a founder. So firstly, it gets your investors off the fence. So by signing your term sheet, lots of investors you're kind of moving them through the journey, and lots of investors will feel more committed to investing than they would if they hadn't signed the term sheet. So it's kind of a signaling of intent. If somebody refuses to sign a term sheet, then they're probably never going to invest in your business, and you can save yourself some time. The second point is it creates an anchor. What do I mean by that? So the term sheet, as I said, summarizes lots and lots of complex legal jargon and concepts. By having something within a term sheet, what you're doing as a founder is committing to including that in the full documentation. So let me pick a really simple example. information rights that I've mentioned a few times before. So an information right is a right for an investor to receive periodical information about a business. So usually you get quarterly information rights. Also, yeah, or investor communications or whatever. What this means is on every single quarter, the founder is committing to provide a summary of where the business is at. So what's the revenue? What are the costs? What's the EBIT? What's the customer acquisition cost in the last quarter? What went well? What didn't? What are we going to do in the next period? What are we going to aim to achieve? What are the risks and issues and things like that? So it's a nice document that lots of investors like. And you would have that as a term in the term sheet. So the term sheet would say something like information rights. The founders commit to providing quarterly updates to each of the investors, summarizing the condition of the business. That's a very reasonable right or protection for each of your investors, and you would put it in the term sheet. Now, if you produce the full form documentation once you produce the term sheet, and there are no information rights for the investors, your investors are going to get grumpy because you have promised something that you are then not including in the later documentation. Yeah, so and therefore that's called an anchor. So you have set an anchor in the ground so that if you try to deviate from what's in the term sheet, or if your investors do as well, so if you've like put your valuation or whatever in the term sheet as a number and investors try beating you up, you can waive the term sheet and say, well, actually, we've agreed the principles of the funding investment in this documentation. It's worth saying at this point, and it kind of is related to the last point, that the term sheet should very much reflect the long form documents. Like I say, your shareholder agreement and your articles are over 100 pages, and the detail there should not conflict with what you've put in your term sheet. If it does, then you've got a real problem, and your investors will almost certainly insist that you change your big documents to reflect what everybody's agreed in the term sheet. On FounderCatalyst, we do this by aligning all of the terms. So if you select something to go in a term sheet, that automatically percolates through every other document. But if you use a lawyer or if you issue a term sheet and then change some settings, those two documents can get decoupled, and it's a real problem. As I mentioned earlier, the term sheet is signed typically by both the founder and the potential investor. So that is a brief summary of what a term sheet is, where it appears, and why you would use it. What I wanted to cover next is a summary of the terms that you will see on a term sheet. This is my mind map, but this is based upon us reviewing thousands of different deals and lots of documentation. And you can see what we've done is split the term sheet into, I can't even count them in time, so the 7 different areas here. Some of these will deep dive in a minute, because actually it's really interesting to look at the deal terms, which is mainly where the term sheet focuses. Let's do this in order, shall we? So we'll start at the bottom here with binding terms. And as I mentioned, most of the term sheet isn't legally binding, but there are 3 items here that potentially will be. Firstly, around confidentiality. So by signing the term sheet, you and the investors are confirming that you won't share each other's details. So you can't say, Richard Branson's looking to invest in our business when he signs a term sheet, because that's covered by confidentiality. And again, legal costs will typically say in our paperwork, for example, that everybody bears their own legal costs. So by signing the term sheets, you're agreeing that you won't pay anybody's lawyers and they won't pay yours, which is really, really standard. And then you get the exclusivity and no shop, which is fairly unusual in an early stage deal. So if you're completing a seed stage funding round in the UK, then normally you'll have 10, 15 investors. So one investor won't want to take the whole of the funding round, and therefore it wouldn't make sense for you to have exclusivity with them. When you speak to VCs, though, it's typically one VC that invests at a time. And they may have a no-shop clause, which means you're not allowed to be speaking to multiple VCs at the same time. So that is optional, and it's rare at a very, very early stage. That would be really unusual at an SEI, SEIS stage. It would be fairly common at a VC stage, though. We then get a structure, details around deal fees. This is usually when a funder, such as a VC or a crowdfunder or an angel group or private equity club, when they're producing the term sheet, they may summarize the deal fees in their document. You wouldn't have this if you've produced the term sheet and you're providing it to your investors. That section just wouldn't exist. Typically, you would summarize the different share classes in a business. This is one of my pet rants as an investor, but the default in the UK when you incorporate a company is that everybody has ordinary shares. So you, any co-founders, any existing shareholders, any investors, everybody just has ordinary shares. And each of those shares has a right to capital, voting, and dividends. Those are the three rights that are typically associated with shares. And everybody has the same rights on their shares, and that is all fair and reasonable. Now, sometimes you may alter the rights associated with shares. So you may have, A shares and B shares, or A ordinaries, or A preferreds, or whatever they're called, and you may vary the rights. So you may have, some shares that don't have voting or have extra voting rights, some shares that offer additional dividend rights, or disallow the dividend rights, or whatever. In most businesses, you will have just ordinary shares for everybody, and the term sheet will say that. If that's the case, it will just be great, everybody's got ordinaries. Anything out of the ordinary on share classes would be called out in this section, though. You then get the basic deal economics. And by the way, this is where investors quite often do push back on a term sheet. The key kind of emotional argument being around the valuation. So you want your valuation to be as large as possible, so you keep as much of the business as you can when doing a funding round. Your investors will look at what normal looks like in the market. So if you're pre-seed, pre-revenue, and you're not in AI in the UK, then your valuation will be, according to Boher, something like 1.4, 1.5 million. If your business is particularly attractive and sexy, like AI businesses at the moment, they're getting valuations at million. If you've got a slightly less on trend business, maybe I don't know, you're making a physical consumer product or whatever, or it's a B2B SaaS platform that is slightly less trendy, then your valuation may drop to 1.2, 1.3 at pre-seed, pre-revenue. So your valuation absolutely will be called out on the term sheet, and will be the first place that every investor goes to try to negotiate. You then get the thorny matter of dilution, and dilution really is a function of what's your valuation and how much you're raising. If you throw if you combine those two things, then that will eventually that will give you what your dilution percentage is, and then you've got the raise amount, how much are you raising. You then get the deal structure. So is it via a price round, is it an agile investment? We've discussed all of these earlier, but these are, what is the mechanism for investing? What is the mechanism for taking on investment? Typically, you would have somewhere in our term sheet, we do this on the last page, but you would have somewhere on your term sheet which discloses what the existing cap table looks like. So who's on the cap table, how many investors do you have, how many shares, and things like that. And one of the useful things that an investor would want to look at is how diluted are the founders. So investors want to see founders with motivation to keep running the business, and if you and your co-founders are at 5% each, that's really not great motivation. So expect an investor to look at, a sophisticated investor to look at that element of your cap table. It's typical here you would also disclose any of these other instruments. So the cap table is what equity have you issued. The stuff in this little box here are the stuff that you have promised to issue. So these items technically, they're not diluting your cap table quite yet, but they will at some point in the future. So warrants, options, ASAs, convertible loan notes, and safes are all promises. They are legally binding promises that somebody can, or almost certainly will achieve, will get some equity in your business, and you need to state those in your term sheet as well. So those are all the kind of non-term, non-deal term items that would normally appear in a term sheet. And then we come down to a bunch of other stuff. So lots of these are, some are UK specific, some are only for more advanced investors. But you will see a combination, some of these appear on every term sheet. So drag along and tag along rights are standard protections for either the company or the investor, actually. Undertakings, for example, and warranties are all standard terms that every investor will expect to see. And over the next couple of slides, we're going to deep dive into these items here specifically, and call out what are standard terms for different levels of investor. So the type of terms you'll get from an individual angel investor in the UK are very different than angel groups or crowdfunding or VC eventually. Yeah, and you can see up here, we kind of group them into, there are some terms that VCs ask for that are just not compatible with SEIS, EIS. So in the UK, if you see any of these in play, your investor just can't make use of these terms, whereas all of these are negotiable and are in principle compatible with the SEIS and EIS. Where you get an interesting grey area, so these terms here are usually just relied upon by VCs, but also foreign investors. So if you've got an angel investor from Europe or America, they can't make use of SEIS and EIS anyway, because they're only UK investors are eligible under those schemes. So you may find that you've got an investor from Spain or America or whatever, and they will push for these terms because they will be much more, angels in those countries will be much more familiar with getting these more advanced terms than UK investors. So let's look at what normal looks like for a normal angel investor. So on this screen, under standard, we've got what does everybody get? So normal investors, whether they're angels, VCs, whether it's via crowdfunding or any kind of early stage, any kind of investor full stop, will expect these rights. What I'm not going to do is deep dive into all of them because there's lots of them and it's complicated, but I'll pick out a few to give you a flavor of what they mean. So drag along is a right. Actually, it's usually a founder and company right protection. What this means is if more than usually 75% of the shareholding of a business decide to sell the business, then they can drag every other shareholder through the process. So if the founders decide they want to imagine that a startup has done one funding round and they've diluted by 10%. So they've got 10% of their cap table are investors and 90% of the business of the founding team. If the founding team decide they want to sell the business, then drag along gives them the ability to sell the business even if the investors may not want to. So you're kind of dragging your investors through the transaction. This is absolutely not usually a protection for your investors. It's a protection for the company and you as a founder. There are some interesting use cases where investors have used this as well, but that's a really weird and wonderful corner case. Almost in every environment, this will be a protection for the company and founders. You then get a tag-along, which is very much a investor protection. So in the previous example, 90% owned by founders, 10% by investors. If the founders could sell the business, could sell their 90% of shares to somebody else, and they're making millions and millions and millions, you would want to benefit from that transaction as an investor as well. Well, under drag, you don't necessarily have to. The founders could sell their shares and you're left in the business with somebody else owning it. So there is a really standard right and protection. Again, this is for investors rather than anybody else, called tag along, and that means if the 90% of shares owned by the founding team want to sell, then you get the ability to tag along to that transaction as well. So the founders can't leave you dangling in the business. Preemption rights, another really standard protection. This one very much is for investors as well. So what are preemption rights? They sound interesting, right? If you're doing another funding round, so if I as an investor have put £10,000 into your business and say I own 10% or whatever, via that £10,000. If you do another funding round, then without preemption rights, you could sell shares at whatever value to new investors, and I wouldn't have the ability to participate necessarily in that transaction. So which feels really, really unfair for me as an investor. What a preemption right is the ability for me the right but not obligation for me as an investor to invest again in your next funding round when you do a funding round, to maintain my share percentage. So after the first funding round, I own 10%. If you do another funding round, then I get the right but not obligation, which means I can if I want, but I don't have to as an investor, invest in that second funding round and maintain my 10%. Now, it's worth mentioning that I have to buy into that second funding round on the same terms as everybody else. So if the valuation's gone from 1 million to 10 million between those first funding rounds, I can't keep investing at the 1 million valuation because that would just be mad. But I have to invest at the new 10 million valuation. But it allows me as an investor, if I want to maintain my percentage. Like I said, I'm not going to go through all of these because there are loads and they're complex. Information rights, though, we've already covered. And where I've got 50% here, that means that around half of the deals that close on our platform give investors information rights, which means that half don't. And we've already mentioned the share classes. So our really, really strong guidance is to give everybody ordinary shares because it makes life straightforward. And it's also 100% compatible with SEIS and EIS. Where you start creating different share classes, you create a risk of creating what's called a preference between your investor shares and another share class. And if your investors get a preference, then you can break their SEIS, EIS rights. We then come on to a bunch of terms that are, these are standard, but for more sophisticated investors. Typically, it will be angel investment networks or angel clubs or private equity clubs or whatever you want to call them. In these cases, then you will often find that the investors are asked for something called board observer rights. So a board observer right is a right for an investor to put somebody on your board. So they sit on your board, but not as a statutory director. So they don't vote. They don't have a voting seat on your board, but they get to watch everything you do, which sounds ominous, but isn't genuinely. It means they get to see the board minutes. They get to sit in the board physically, and they have access to any of the material the board does. So it gives the investors kind of eyes and ears on your board to kind of observe what's going in the business. And usually a board observer is somebody there to help. They will sit there and go, oh, have you thought about this and why are you doing that? So it's a really nice way to get another kind of independent third party on your board to help out. You then get an investor director, which is similar. It's a right for an investor to put what's called an investor director on your board. They get access to all the information a board observer do, but crucially, the investor director is a statutory director under law. So they do have the right to vote in your board. They can, they can do everything a statutory director can in your business. So yeah, that one's slightly harsher, and ideally founders will push back on that at an early stage at least. And more sophisticated investors may document, for example, and may want you to document what happens with the director's loan. So do you want the paperwork to be silent? Do you want the founders to have to capitalize their director loan, i.e. buy into equity at the current funding round valuation? Or do you want them to keep the loan hanging around and be able to pay out free profits in the business? So that's sometimes documented, and also option pool created. So lots of investors will insist that you create an option pool before rather than after a funding round. And if they do insist on that, then the concept will be documented in the term sheet and then embodied into the shareholders' agreement. We then come to the next group of investors, and these terms are getting ever more harsh. So, sorry, the first group are some SEIS, EIS compatibility terms that are pretty harsh, and you would usually see these in the UK via SEIS and EIS funds, who have the harshest terms in an SEIS, EIS context. So you would get, they would force you to capitalize any director loan. They would force you to create an option pool before the funding round. Both of those are very investor friendly and therefore very founder unfriendly. I can explain why if anybody wants to dive into that in the Q&A. You would then have within the term sheets potentially documentation around what fees do the SEIS funds take. They may take 5 or 10% of the money you put in, what monitoring fees and things like that. So that's about as harsh as the term gets, as toxic as the terms get under SEIS and EIS. And then you come to non-SEIS, EIS compatible terms. And these are typically used by institutional investors, foreign investors, and VCs, as mentioned there. So you get things like liquidation preferences. And a liquidation preference means if I'm an investor and I put £100,000 into your business, then if you exit via any reason, so exit for a good reason, i.e. you sell the business, or exit for a bad reason, i.e. you close the business or the business goes into liquidation, then as an investor, I can take my investment out first, out of any money left. But also I can have what's called participating liquidation preferences, where I take my money and then I take my money again. So I take I double dip and take double the money that I've put in, which is for you as a founder bad, because it's reducing the amount there is for you to benefit. You then get anti-dilution and non-dilution shares, which are they're really rarely seen in the UK. Non-diluting shares are virtually never seen because they make you uninvestable. And then we get up to a bunch of terms that are harsh even by VC standards. So things like board swamping, for example. So if VCs don't like the way that your business is being run, they can swamp your board, which gives them more seats on your board than you do as a founder, and means that they can therefore vote they can vote through any proposal they have and vote against any proposal you have. I won't go into any more detail, but you can kind of understand that these terms are, very investor friendly. The problem with terms in a funding round are they're either investor friendly or founder friendly. It's a zero-sum game. So if the investor's winning something, then you are losing something. So that's really worth bearing in mind in the negotiation. And ultimately, as an investor, where I see I want to get to, I want my rights and protections protected, but really I don't want to beat the founder up too much. There is a happy medium, usually called market standard, where everybody wins. You as a founder, you're happy with what you've got the enough control to be able to run the business as you see fit, but the investors have kind of oversight and rights and protections to make sure that they're protected as well. There is a really interesting, I'll give you one case study and then we'll come on to kind of the questions and answers. But we mentioned drag along earlier, and this is the reason why I want to mention it, is because drag along is in theory it's in theory a founder protection. It means if you own 90% of the business and you're selling the business, you can drag everybody else along through the transaction as long as you own a certain percent. So that's a very founder friendly sounding thing, right? What you can also see in more, and there's an example called FanDuel, and I'll send if you haven't seen it, Google FanDuel liquidation preferences. There's an example where a VC invested in the company called FanDuel, and there were investor drags, and the investor forced the sale of the business even though the founders didn't want to. So the founders owned a big chunk of the business. They owned, I think the founders, the junior VCs and the original angel investors own 60 or 70%. But the two VCs that came to the party last had what are called, investor drag rights. So those two big VCs forced the sale of the business without anybody agreeing to that. So that is all pretty harsh to start with. There was also the use of another term that we mentioned there called liquidation preferences, participating liquidation preferences. So the VCs actually sold the business for, I think it was $500 million that the sale price was. Unfortunately, the terms of the liquidation preferences meant that those two VCs that invested last took 100% of the proceeds. So the founders, the original angels and the junior VCs got absolutely nothing, even though a business sold for many, many hundreds of millions of pounds. So those are two terms, both investor drag and liquidation preferences, that worked against the founders entirely. Yeah, no, great question. And I guess the valuation is the easy one to go at, because everybody understands valuation, and ultimately we all want the most bang for our buck, don't we? We all want to own the most shares we can in a business for our investment within reason. So yeah, I think valuation's just the standard. Expect to be beaten up on your valuation as a founder. That's just the rules of the game, I'm afraid. So yeah, in terms of other things I look for, and you did clarify, was that from an investor point of view. So I've been bitten. So I got 32 investments, and you don't make 32 investments without being bitten once or twice by mistakes along the way. And so what are the things that I personally look for? So one is information rights that I've covered at length, so I won't go over here, but I genuinely want to know what's going on in a business. Without information rights, the founder can just go to ground, and I can never hear from them again. And I've got a really horrible example of that, where I invested in a business. It was only £20,000, but you still know. And there's SEIS loss relief, but I put the money in the business, never heard from the founder again, and I found out the business had been closed when I looked at Companies House, so it had been liquidated.
Wow.
which is bonkers. So yeah, genuinely, I always ask for information rights, even though founders are like, it's a distraction, you know, I don't want you peering over my shoulder. I'll just give them that example of, you know, that bad behavior I've seen from a founder, go, well, this is why I'm asking for it. And for me, that's a, you know, that's a red line. I'll walk away if a founder won't give that, because it's indicative of, you know, a broader challenge, I think. The other thing that I ask for, and this is, again, having been bitten, I will ask for investor consents. So investor consents give me, you know, if somebody wants to liquidate their business, then they can't do it if I've got investor consents. It's a contractual obligation that they get the consent of 50% of the investors before they do it. Now, that shouldn't be necessary, right? Everybody should play nicely. But if out of 30 investments that I've made, one of those, I've seen these things occur, you kind of think that. So I think roughly half of the, what is it? Sorry, let's take a step back. What's an investor consent? Because I didn't call out on that. It's a big list of things that you can't do in your business without 50% of investors agreeing to it. So if I want to change my accountant, change the company name, change the company's trade, close the company, give myself a director's loan out of the business, whatever, you know, all of those kind of things, pay a dividend, which usually benefits a founder more than an investor. All of those things require something called investor consent. And for me, I always insist on it, because I've been bitten in a few instances where an investor consent would have protected me. Lots of the other stuff we spoke about, you know, drag, tag, preemption, they're just given, they're not negotiable. If you're not willing to give preemption rights to your investors, then you're going to have a very lonely cap table, because people won't invest on it. So I think those, yeah, information rights consents are kind of the market standard for sophisticated investors.
Yeah.
And then you get the really weird corner cases. So there's something called a liquidation priority. Now, liquidation preferences aren't compatible with SEIS, so you never see them in early stage rounds. But there is this weird, there's this contract called a liquidation priority that does a very similar thing, but uses some weird accountancy and legal tricks to do it. And you virtually never see that other than via the SEIS funds. But as an investor, I'll check that that isn't on the cap table, because if I see somebody getting a liquidation priority, it means that those investors who are paying the same for the shares and have the same share class and everything as me, they actually have a benefit to me, because they're getting their money out first in the collapse. Yeah, and just to finish off your point there, Sam, it is very standard that SEIS investors come in, VCs come in here, and they'll take a preference. So they will always take a liquidation preference. As an investor, I don't like it, but it's the rules of the game, and you kind of go, and I do think there is an argument for that, because SEIS and EIS investors, I'm risking 28% of my cash. When I put 10 grand in, the most I'm going to lose is 2,800. The way VCs similarly de-risk is via anti-dilution and liquidation preferences. So I kind of think, well, it's fair. I'm, no matter what happens, I'm minimizing my risk. The problem I have with a liquidation priority is that those investors are making use of SEIS, EIS. So it's cake and eat it. They're getting the protections of SEIS, EIS, but they're having a layer of something on top, above and beyond what normal SEIS, EIS investors get. So as a relatively sophisticated investor, that doesn't sit well. So for virtually all early stage investors, as I said, founders produce the term sheet and hand it to the investors, and then they negotiate. When it comes to more sophisticated investors and crowdfunding for this purpose fit into that, there is the crowdfunder will typically have an offer letter or an indicative offer letter or something like that. And that basically supersedes whatever you've got in a term sheet. So if you're working with Seeders and Crowdcube, they both have very specific terms that they will insist on: information rights, consents, creation of an option pool. All of those things will be documented in an offer letter that they send you. And then it's your responsibility as a founder to make all of your documentation match their requirements. At FounderCatalyst, you can select when you're adding your company, you select who your investors going to be. And you can select it's either Seeders or Crowdcube or whatever. And that will ensure that the documentation we produce is a perfect match for those types of investors. But yeah, sometimes for normal angels, you'll never get a term sheet from them. For some private equity club and angel networks, you'll get an indicative offer letter which says, we will invest if you offer drag tag preemption, consents, yada, yada, yada. And the same is true for crowdfunding. So I think that was point one anyway. Yeah, I mean, in any funding round, you're usually looking to dilute by 10, 15, 20%, something like that, with 15 being the average. If you find yourself diluting at any stage by 50%, then your cap table has a real problem brewing. It kind of depends how much. If you know you only need one funding round for £100,000, you can afford to be more generous with your valuation, because you're never going to raise again. Family and friends owning 20% of your cap table for 100k, that's not market standard, but it's not catastrophic for the business. If you know you've got 5 funding rounds to do, then you're going to do those in tranches. So your first funding round, your valuation is going to be around £1.5 million pre-seed pre-revenue, and then it will hopefully jump when you prove traction to 2 million, then 5 million, then 10 million. Specifically around family and friends, your parents and friends probably aren't that sophisticated to understand the term sheet, and they certainly won't understand the shareholder agreement and articles. So it really, lots of it's done on trust. The family and friends are just done in a different way. And actually, for a family and friends round, having 100 pages of documentation is kind of an overkill, right? So sometimes it's a vaguely nice use case of an advanced subscription agreement where effectively it's a 4-page document where your mum and dad or whatever are saying, great, we'll give you 20k and we expect 2% of the shares, and that's that, and you kind of put it in the drawer. And then when you do a later funding round with more sophisticated investors, your parents would benefit naturally by the rights and protections in those documentation. So friends and family, you can absolutely use our platform. You can use an ASA. It's when you get those more arm's length, it's when there's less trust between the investors and the founders, really, where you need to formalize things much more. Obviously, a forecast is forward-looking rather than backward-looking in its very nature. So if you've got a more mature business that's been going for a few years, then people can look at your actuals, right? They can, as part of your pitch deck, you would include a graph which would show hopefully the half hockey stick and show the business. Forecasts will look and have different justifications, whether they're pre-seed, pre-revenue, or whether you've actually got revenue and you're on your journey. There's one thing to say as an investor about forecasts is they're wrong. I know they're wrong. They're wrong. Everybody in a transaction knows that the forecast is going to be wrong. And sometimes it's a nice surprise, but virtually always, your business is going to take longer to achieve than what you said. Sales are going to come later. It's going to be more expensive. It's going to. There was a great survey somewhere. Somebody looked at kind of forecast pitch decks and forecasts, and then looked 2 years later at what was actually achieved. And the forecast in 99% of times had been, optimistic by every margin. So yeah, firstly, I'm going to be really cynical. And for me, a forecast isn't really about the numbers. It's more about looking at your thought process as a founder. So. Is it a really scrappy forecast with, calculation errors and spelling errors, and it looks like my 3-year-old daughter drew it with crayons? That's not a great sign, and that's a real problem. Or is it a sophisticated model with lots of variables showing assumptions that you can tweak? In a well-presented format that shows you understand the business, you understand the customer acquisition cost and how that feeds into your cost of sale, and how that impacts revenue, and what your break-even points are. And it's, you can tell a lot from a founder's thought process by seeing a forecast, even if you're completely cynical on what the outcome is, which every investor should be, really.